Have you ever looked at a company's financial statements and thought, are those assets really worth what's showing on the books? That's exactly where impairment testing comes in. In today's video, we're breaking down one of the most misunderstood areas of financial reporting: impairment of assets. By the end, you'll know the step-by-step process under IFRS, how it compares to ASPE, and we'll walk through practical examples so you can apply this on exams and in real life. But before we dive in, if you find videos like this helpful, make sure to leave a like and subscribe to Canada Accounting Insights. That way, you won't miss out on clear, practical lessons that make complex accounting topics easy to understand. All right, let's get started. Let's begin with the basics. An asset is impaired when its carrying value, that's cost minus accumulated depreciation or amortization, can no longer be recovered, either through use or through sale. In other words, the balance sheet is overstating its value. The goal of impairment testing is to make sure assets are carried at no more than their recoverable amount. This keeps financial statements reliable for investors, regulators, and decision makers. Now that we know what impairment is and why it matters, let's walk through the actual process step by step. Under IAS 36, the impairment process is a four-step model. Step 1. Determine the level of asset grouping. Impairment is ideally tested at the individual asset level, but sometimes cash flows can't be separated. In that case, we use a cash-generating unit, or CGU. Think of a single store in a retail chain, or an oil field. That's your CGU. Step 2. Identify when to test. Most assets are tested when there are indicators of impairment. For example, internal signs like damage, obsolescence, or discontinued use, or external signs like a decline in market value, legal changes, or rising interest rates. Some assets, like goodwill and indefinite life intangibles, must be tested every single year, even if no indicators exist. Step 3. Determine the recoverable amount. This is the higher of fair value less costs of disposal, or value in use, the present value of future cash flows from the asset. Step 4. Compare and record the impairment. If the recoverable amount is lower than the carrying amount, the difference is recorded as an impairment loss. To really see this in action, let's look at a quick example. Imagine Danny Corp has equipment with a carrying amount of $45,000. After testing, the recoverable amount comes in at only $40,000. That's lower, so the company must record a $5,000 impairment loss. The journal entry would be debit impairment loss, $5,000. Credit accumulated impairment loss, equipment, $5,000. That's a straightforward example at the individual asset level. But what happens when impairment applies to a group of assets instead of just one item? Let's see. AB Media Corp has a printing division. The entire printing division is treated as a CGU, with a carrying value of $1.45 million. The recoverable amount, based on discounted cash flows, is only $1.368 million. That's an $81,650 impairment loss. And because this applies at the CGU level, the loss must be allocated to the assets in the division proportionately, usually to the building and equipment, but never below fair value. So far, we've seen how to record impairments. But what if circumstances improve? Can impairments ever be reversed? Let's talk about that next. Here's something that often surprises students. Under IFRS, impairment losses can sometimes be reversed. If circumstances change and the recoverable amount increases, you can write the asset back up, but only to the value it would have been if impairment had never been recorded. For example, suppose equipment was impaired by $300,000 2 years ago, but today the market has recovered. You can reverse part of that impairment, subject to limits. The big exception: goodwill. Goodwill impairment can never be reversed. And speaking of goodwill, let's turn to intangible assets. Intangibles are tested in a very similar way to tangible assets. Finite life intangibles, like patents or copyrights, follow the same rules as PP&E. Watch for signs of obsolescence or declining revenue streams. Indefinite life intangibles, such as trademarks, must be tested every year, even without impairment indicators. Goodwill is special. It's never tested on its own because it can't generate cash flows independently. Instead, it's tested as part of a CGU. If impairment exists, goodwill takes the first hit. Importantly, goodwill impairment can't be reversed. Once it's gone, it's gone. This brings us to an important comparison. How does all of this differ under ASPE? For Canadian accountants, knowing both frameworks is critical. Level of testing. IFRS uses CGU. ASPE uses broader asset groups. When to test? IFRS requires annual consideration of impairment indicators, plus annual tests for certain assets. ASPE only tests when events suggest impairment. Measurement. IFRS uses discounted cash flows or fair value less cost to sell. ASPE starts with undiscounted cash flows. If those are lower than carrying value, you move to fair value to determine the loss. Reversals. IFRS allows reversals for assets other than goodwill. ASPE does not allow reversals at all. This means ASPE generally results in fewer write-downs compared to IFRS. Now let's tie everything together before we wrap up. So here's the big picture. Impairment is all about preventing assets from being overstated. Under IFRS, follow the four-step model, test annually for goodwill and indefinite intangibles, and remember, reversals are allowed. Under ASPE, the rules are more event-driven, cash flows are undiscounted, and reversals are not permitted. If you master these differences, you'll be ready not just for exams, but also for real-world financial reporting. If you found this breakdown helpful, don't forget to hit that like button and subscribe to Canada Accounting Insights for more clear and practical accounting lessons. And let me know in the comments, do you find impairment testing straightforward, or is it still a bit of a headache? Thanks for watching, and I'll see you in the next video.